This week on Sylvia's Traders Lounge.
What I'm looking for is a base, essentially a box. I'm going to call these Darvis boxes, where basically the stocks just trade inside of a range for a while, and then finally make a breakout to the upside. When this happens, we have a much higher propensity for the market to follow through to the upside than not. Depending on the market conditions, individual names, this can be upward of over 70% success rate, which is really, really good. It gives you very good odds over the course of a career if this is what you focus in on.
Sylvia's Traders Lounge welcomes you all to yet another webinar where we learn, trade, and profit. We shall be giving you trading insights on technical analysis, fundamental analysis, risk management, and trading psychology. Michael Tedeschi is our guest for today, and our theme is breakout swing trading and risk management. Michael has been passionate about the stock market for as long as he can remember. After he graduated from St. Mary's College in Maryland, he started a stock trading website to help people become educated about both fundamental and technical analysis. He also worked one-on-one with his subscribers to help them better understand the markets and psychology of investing. He loved running his website, but wanted to take the next step and start managing investments professionally. He then helped start Perspective Wealth Planning, where he has the role of wealth management advisor. He is excited that he is again able to offer one-on-one coaching program to help people navigate the ever-changing markets. Welcome, Michael. It's truly an honor to have you back on our lounge.
Thank you for having me back. I'm glad to be here.
Yeah, and for the second time, maybe you can just give us a brief history into your trading once again, and then also transitioning to becoming a wealth management advisor, how that has been for you, and also in these COVID times since the last time we spoke.
Sure. So I have over a decade of money management experience. I got a degree from economics out of St. Mary's College in Maryland. And while economics is a useful degree when you're thinking about trading, an actual better degree would have actually been psychology, right? Because as we'll get into it, really charting is human emotion graphed. So fully understanding what the masses are doing is almost more important than the economics behind it, especially when we're focusing in on the technical trading side of things. I've been lucky enough that the job that I've had for the last decade and a half really has allowed me to work out of my house. So in this COVID era, I still am working out of the house. I have 9 computer screens, so it's very difficult to pick that up and take it into an office every day. So I have an office in my house. So I have been able to continue to do what I've been doing without really any interruption. And I know that I'm extremely lucky given what everyone else on Earth has been going through here over the last year and a half. I think I touched on all your points there.
All right, yeah, and your journey to becoming a wealth management advisor, if you can tell us more about that.
Sure. So I launched my own website. It was Charts Don't Lie back about 10 years ago. And I ran a independent day trading chat room. I wrote a financial newsletter. And I coached people one-on-one and had so much success from that. I had a ton of people ask me if I would actually manage their capital for them. And in order to do that, you have to get licensed. And so I actually went into business and started Perspective Wealth Planning, where I got, my Series 66, 7, life and health. So I can offer full financial planning and money management. And now I actually manage the portfolios per Perspective Wealth Planning. We have 5 different portfolios, and based on an individual's risk tolerance, we actually blend different strategies together to give them the best potential upside while mitigating risk based on their longevity, their timeframes that they're looking at. And so that's been an awesome change. I absolutely love what I'm doing now. I've been doing it now for about 4.5, 5 years almost. And I'm very glad that I made that switch.
All right. And the last time when we were talking about how traders can cushion themselves against the COVID pandemic, and using now risk management. Maybe you can tell us how you do that, how you allocate risk, and how you trade as a breakout swing trader.
Sure. So when we were speaking last time, it was kind of right in the midst of of the panic last year, right?
Yeah.
And had the central banks not stepped in, the market would not have had its beautiful bounce. I mean, we really sold off almost 40% on the S&P 500 in about a month's time frame. But we've now printed more money than we ever have in the course of history. So that really did give us that cushion. When I get into sharing my screen, I can actually go through some of the bottoming process that we had seen and why you could technically have looked at where the market was and made a good risk managed bet at that point. So I'll certainly get a lot more in depth in that a little bit later in this webinar.
All right. And then also you will demonstrate to us how you marry the breakout swing trading with risk management tools or the models that you normally use. So meanwhile, you can tell us, because I know you're big on indices trading, among any other asset instruments that you trade. Maybe you can take us through your trading process from idea generation to your execution. And you can feel free to share your screen now as you go towards your presentation.
Okay, sure. Let me make sure I pick the right screen.
All right.
All right, so you should see a chart of the S&P 500 up on the screen.
Yeah.
Okay, great. So first off, let's talk a little bit about the risk management, because I want to get into answering your question from the low from COVID. So what I've got up on my screen now, this actually chart goes all the way back to 2000. This is a monthly chart of the S&P 500. I actually can back it all the way out to the 1970s, but I don't think I need to go back that far. What I look for is major price action levels on a chart. And so if we zoom in and we look at 2014 to 2016, we ran into about that 2100 level on the S&P 500, and we couldn't get through it for the longest time. In fact, we tested it multiple times, and then we fell back from it. When we finally ran up into this zone and made this breakout right here, this is the breakout type of trade that I look to take for my swing trades. Right. And it doesn't matter if you're looking at a monthly chart, an hourly chart, a daily chart, a weekly chart, whatever time frame you're trading on. What I'm looking for is a base, basically essentially a box. I'm going to call these Darvis boxes, where basically the stocks just trade inside of a range for a while, and then finally make a breakout to the upside. When this happens, we have a much higher propensity for the market to follow through to the upside than not. Depending on the market conditions, individual names, these can be upward of over 70% success rate, which is really, really good. It gives you very good odds over the course of a career if this is what you focus in on. The longer something stays inside of a range like this, when it breaks out, you usually have a much more powerful move. Now, when we get a breakout like this, that level that we broke out from used to be resistance. It now should act as support. And if I look at where we went at the low of COVID, our low came right into this zone. So from a technical standpoint, we had a breakout and we back tested this area. This gave you, if you wanted to buy into that carnage, a very good risk controlled bet, because you could make this play and you had a key level on the chart that you could key against. And so by doing this, you ended up with a absolutely fantastic entry point. But if you were focused solely on just breakout trading, you didn't need to make any play until we kind of broke above this zone in here, and you got a very good trade in as well, because this is where we make new all-time highs. And when you look at buying breakouts, you use the last key low as your stop, and the last key low would have been back in here in this zone. So you could have last year taken that entry point in about August on the S&P 500 around that 3350 level with a stop against 2900, and that trade is still clearly working to today. Now, when I manage risk, I do it in a number of different ways. This is the most important aspect of trading, regardless of what style system you use. Every single successful investor trader all has some sort of risk management technique that they utilize, because if you don't, eventually the laws of averages are going to catch up with you. So when I manage risk, I first and foremost focus in on position sizing. Okay. And so what I mean by that is I look at the level where I want to buy something, and I look at the level where I don't want to own it anymore. So in this particular example, we bought the S&P 500 around 3,400, and we set that stop back down here, right? I calculate how much risk per share I am taking for this trade, and I calculate my position size. Now I make math easy. Let's say this was a $10 stock, and this stop down here was $9. I would take $10 and I would subtract one, and I would subtract 9, and I would get $1. I'm risking $1 per share. And I would look at my total account value. Let's say, hypothetically, it's 100 grand. The risk that I will take per trade idea is 1%. 1% of 100 grand is $1,000. So what I would do is I realize I'm risking $1 per share, and I can risk $1,000. That means I could buy 1,000 shares of this $10 stock, which would be equivalent to buying $10,000 worth of that stock. So I would be only putting 10% of my portfolio into that name. Now, if this stop was 50 cents instead, so instead of it being $9, it's $9.50, now I would be risking 50 cents per share. I would be able to buy 2,000 shares. And in 2,000 shares, that would be 20 grand. And if it was 8, then I would be buying less. So it would be $2 per risk. I'd be buying 500 shares. So the first thing I do is focus in on position sizing. That way, every single trade idea that I have theoretically has the same risk of around 1%. I'm not placing any more credence on any individual trade, because I view this really as, an average over the course of a long run. I want to take the same setup 100 times, knowing that I'm going to win 75% of the time. And I don't want to take on too much risk on any one trade, because then you run the risk of really hurting yourself. Now, there's a couple of other pieces that you need to put in on this. When you buy any stock and you're holding it overnight, technically all of the money you have is at risk. So what is the most amount of money that I'm willing to lose if something were to, say, go to zero overnight? And I would never want to take more than really a 10% loss in any individual name. At a 10% loss, I need 11% to get back to even. It hurts, but it's very doable. If I were to put 50, 60, 70% of my capital into one name and something crazy happened overnight, that would be devastating, and that would be something you really can't come back from. Because again, if you lose 50% of your account, you need to double it to get back to even. So we really need to keep our losses small. So in this example that I gave, if my stop was 50 cents, so it was the 950 level, and I could buy 2,000 shares of this $10 stock, that would be 20 grand. I actually wouldn't buy $20,000 worth of the stock. I would keep my position size to no more than 10% of my account for individual idea names. It would be different if I was buying an index. The S&P 500 is not going to zero overnight, but an individual stock could. So I will take a little bit more risk on, let's say, ETFs, where there's a basket of stocks instead of individual names. Now, when we think about risk management from those two things, there's one more thing that we need to think about. How many plays can I have on at one time? The market is a lot more correlated than we think. And this was a very clear last year. Almost everything took this drop together. Right? So it didn't matter if you were invested in Apple or Tesla, or you were invested in an oil company or anything really. It all took really big hits. And so if you have 10 plays on at the same time that are 10% size each, and something like this happens, you very well can lose a large percentage of your account, which as a trader doesn't make any sense. As an investor, you need to have your capital working. So I'm talking just from a trading standpoint at this moment. I won't put more than 3 to 5% of the trading portfolio at risk at once, meaning I'm not going to have more than 3 to 5 positions at a time at a 1% risk. If there's so many good ideas that are going on at one time, then maybe I'll take half position sizes and take 10 positions at 0.5% risk instead of 1% risk. That would still leave me the same 5% overall risk. So if you manage your risk in 3 separate ways: position sizing to appropriate stops, then you think about how many stocks you can have on at one time. And then you think about making sure that none of your individual positions are too large to hold overnight. If you do those 3 things, you have really set yourself up to avoid those large down draws, which really, really hurt traders and actually knock a lot of traders out of the game completely. So that's kind of my philosophy in on risk management. Did you have any questions on that before I continue on?
No, I think you can go on.
Okay, give me 1 second. So Next, let's start talking about breakouts. So you want to know the process I look for. Before I share with you how I find individual names or different sectors and everything, I want to talk a little bit more about that Darvis box and that breakout type of trade. So here's the S&P 500 in between August and basically November of last year. And we can clearly see that we're between 3,200 and 3,500. We run up to the top, we fail. We come back to the bottom, we bounce. We run up to the top, we fail, so on and so forth. This is the pattern I look for when stocks are near their all-time highs, because when it breaks out from this pattern, it tends to follow through again that high percentage of the time. So I am looking for this type of setup in a bull market. All right. Markets can do three things. They can go sideways, they can go up, and they can go down. So right now, if we look at the Russell 2000, the Russell 2000 is just trading sideways and has been the whole year. In fact, it's in essentially that boxed setup. So I'm not trading anything inside the Russell at the moment because this is a sideways mess. This is not for breakout trading. If we break above that 2360 level in the Russell, I'm definitely very, very interested in getting in because this is an 8-month-long base, and this usually is going to have a pretty powerful move once it leaves this zone. So I haven't been focusing in on the Russell components this year because they haven't gone anywhere. At the same time, when we look at the NASDAQ keeps breaking out. So here's a beautiful range, and this is even more powerful than the Darvis box. This is called an ascending triangle, okay? Because what we have here is we have a flat top, and then we have higher lows, right? So that creates that triangle. When we break out from that, that ends up being a very powerful setup here. Sorry, clearing those drawings out. I want you to think about this from a psychological perspective as well. When we have a flat top, what the market is saying, everybody is in agreement. When we get up into this zone up in here, prices are too high. So the bulls, they take their shares and they sell some of them, they book some profit, stocks fall off. The short sellers go, this is a great level to short, they start shorting. And so you have two things working together up at this zone, and you can see we fall, and we fall the second time as well. But if you think about what's going on the other side of this, the first time buyers let the thing fall this far before they step in and buy. On the second push down, they go, there's no way it's going to fall back down here. I need to get in earlier. And so when you see higher lows getting put in a pattern like this, it's showing you underneath the surface that buyers are actually winning the battle, right? This doesn't matter until we make our breakout up here, because we clearly still could have run right into this zone and then rolled over. So for me, I wait for that confirmation. And when we get that confirmation, we get a very easy entry point. So those are the two types of breakout trades that I will take. I'll take Darvis boxes like we have right here, and I'll take those ascending triangles as well. I prefer the ascending triangles over the Darvis boxes because, again, it's showing you underneath the surface that buyers are already in control. They just need to break it out. So we can look at all the different indexes, and I actually am going to take a look at a lot of different areas of the market, kind of give you an overall market analysis here in a minute. But my process is focused in on finding names that have setups like this that are breaking out to new all-time highs and making those buys on those breakouts and setting my stops back underneath the last low, and then taking that trade for a move higher. Now, the way I find my targets on trades is I take the box, that last low to where the breakout point is, and I use fib extensions. All right. So it's a fancy way of doing 1.24 2 times and 3 times whatever the range is. Meaning, if this was a $10 range and I used the fib extensions, it would be 1.24 times the size of that range, which would be $12.40. So if this was a $10 range, I'd add $12.40, and that would give me my first target. I would add $20 or $30 for my second and third target. I am usually taking half or all of my money off at the first target and then going for the second target with the last half if I have any left. That is my process. So I am getting 1.24 to 1 on the first half of the money, and I'm getting 2 to 1 on the second half of the money from my entry point versus where my stop is. With a win percentage, again, of over 50% on breakout trades in a bull market, those give you very, very good numbers over the course of hundreds of trades. Do you have any questions on the breakout strategy itself?
Maybe you can touch more on the entries and the exits.
Sure.
Given the ratios here.
So let's just pull up, I don't know, let's take a look at the Dow this time. So the Dow right here, while we did go and make a new all-time high, it was a marginal high, right? The last couple of days, it's kind of fallen back. I kind of view this whole area in between like 35,000 and really like 35,600 now, kind of as this resistance zone. We can see that we have these higher lows coming in. So buyers are stepping in sooner and sooner. The area that I want to buy would be up here on this breakout right above that 35,750 level, right in here. I would take my entry point right here, and I would set my stop against the last important low, which at the moment is right here. And you can see it is important, not just on this day, but also on this day right here. So it's got, 2 times kind of that level of importance. What I am betting on here is that we are not going to make a lower low, because an uptrend is defined as higher highs and higher lows. So as soon as we make a lower low, we're no longer in an uptrend. So I would take my entry point right here, and I would have my stop just underneath of right here. Now, I use something for my stop called an ATR, which stands for average true range. We've all seen it where the market comes down, and here's a really good example. I'm going to zoom in for you guys to be able to see it. If you were using the previous low, this day comes down and stops you out and then turns around and reverses. The way that you can avoid that is by picking the level on the chart where you don't want to own something, and then using one ATR, which stands for average true range, which is the average size price movement of a daily or whatever chart time frame you're looking at candle. So in this example, the ATR on the Dow is about 270 points. So I would take 277 points and subtract it from where I want that stop to be. Okay. And so my stop would be back down about right here, my hard physical stop. So I would actually not get taken out on this. If it goes below one ATR, usually it's going to, continue to follow through. So that is the way that I figure out how to and place my stops. I pick the level I don't want to own, and then I actually move it back one ATR. So here we're about 34,670. So we take 270 off of that. So we're going to be back down at about 34-ish. Right in this zone would be my hard physical stop. Now, if we close the day, or we're going to close the day inside this range right in here, I will get out of my position. So I have a hard physical stop in the market, one ATR below, and I'm okay with during the day a stock coming down, and as long as it comes back up above that line. If it comes down and it stays inside this zone, I will get out of my position. I don't need to let it go all the way down here, because I'm focused in on as a swing trader on the closing candles. That's what's important. All right. And same thing on my entry points, right? If, and I give you an example from right here. Let's say this was the level I wanted to own it above. Let's just pretend that there was, this candle right here on this day came up to this spot. So it clearly, like, we have resistance right up here. During the trading session, we got above it, right? So we pushed up above. But as a swing trader, I don't really care what happens during the day. I need it to close above it. And the fact that it doesn't close over this means I'm not going to buy. So on a swing trading standpoint, I am waiting until really the last 15 minutes of the day to figure out if we are going to close above or below that breakout level. And if it's going to be above, I'll take that entry point. Now, like any system, there's downsides, right? If I wait until the end of the day, sometimes we have those days where the candle just, we open and we just keep on running. And now we have this huge candle all the way up here. I can't buy this all the way up here anymore. It's now too far away. So sometimes if you wait for that confirmation by the end of the day, you'll miss those really big moves where the stock just opens at the beginning of the day and runs all day. But if you wait until the end of the day, you will have a higher win percentage. You will miss some trades, but you will have more things that follow through because you got that confirmation. All right. Regardless of whatever your system is, you can buy it as soon as it breaks out. That's fine. right? I have just found over the years that waiting for that confirmation, while again, I'll miss some of the trades, gives me a better numbers over the long run. Does that answer any of your questions for the entries and the exits?
Yeah, it does. And do you ever make use of trailing stops? Maybe you can show us an example if you do.
So I don't like to use trailing stops. I'll explain why. I think trailing stops work well for like intraday trades if you're trading intraday, so that you can try to catch some of those really big trending moving days. But if you use trailing stops on something, you always have to figure out how far away do I set that stop, and then you also have to figure out whether or not that's actually important to the market or not. So let me give you an example. Let's say we take this breakout right here. Okay. And let's say you were using your ATR, maybe you use two times the ATR for your trailing stop loss, because that's something I know some people do. So it's about 500 points. Okay. So what happens is you enter this trade right in here, when you get your, actually it would be on this day here where you get your close over the level. So let's say you're up here at about 32,700-ish, right? Really where I would place my stop is all the way back down in here, right? Because that's the last kilo that's on this chart. That's where I'm wrong. If you place your 500-point trailing stop loss, here's what happens. You get stopped out, let's see, about right here, right? Because it pushes up and then you get taken out. Now you've booked profit that way. There's absolutely nothing wrong with that. And you avoid, another 2% pullback, but then look what happens. You avoid the rest of the follow through to the upside, right? If I'm looking at this and I'm drawing how I would trade this, my target's here. If I use a trailing stop loss, look what all of a sudden happens. I'm getting stopped out in the middle of this zone right here. Look at now what I've risked versus what I get. I have captured 700 points, 770 points against a stop of 1,700 or 1,400 points. So I got 1 to 2 on my money. So for every dollar I risked, I made 50 cents. You can't take profits early consistently because all of a sudden your risk is out of control. So when you're right, you win $100. When you're wrong, you lose $200. You now need to have a win percentage of higher than 66% to be a break-even trader, which is not an easy thing to do. Now, once you've gotten to your first target and you take half off, if you want to use a trailing stop loss for the rest of it, your math will still work in your favor, right? So I've seen people do that, but I can't take a trailing stop loss right off of the bat. It just doesn't work the way that I've seen. If you use a trailing stop loss and it works out for you, there will be times where you will get a lot more money than I will on a trade, because let's just say you've got something that just kind of goes straight up for a while. All right. You'll get this whole move where maybe my target was only to right here. So I'll be out here and you'll take this whole ride, and then maybe you get your down draw here. You'll get out up here. So you have the potential to make more money with that trailing stop loss than you do without it. Again, I'm looking at this from a straight math numbers perspective. I know if I'm risking $10, I'm going to make $12.40 on the first half. I'm going to make $20 in the second half. I know my win percentage is over that 50% mark in a bull market. And I know if I do that exact setup 100 times, then I'm going to end up well ahead. So I don't really want to mess with those trailing stop losses, which will get me out of a stock at random spots on the chart that actually aren't important.
All right, understood.
Okay, so now when I'm talking about individual names, there's lots of ways that you can find individual plays like this. I use a screener, and here's how I have my screener set up. I look for stocks that make new 52-week highs, that have volume of more than 1 million shares a day, that are optionable, and that are larger than $2 billion. That's the main screener that I take a look at. And the reason I have those parameters set is a couple of reasons. One, if I had no parameters set besides just making new highs, I would have way too many names to take a look at in a bull market. I mean, I would have like 500 plus names a day to take a look at. And we need to figure out a way to take that list and lower it down to a level that we actually have enough time to look through and have better names in them. For me, liquidity is important. I'm managing large sums of money. I can't get into small cap companies that have very little volume. So I want to make sure that we can have 1 million plus shares traded a day. So there's going to be liquidity. I'm not going to worry about moving the market on myself. I'm going to be able to get in. I'm going to be able to get out easily. And then I like to focus on those 2 billion market cap companies or bigger, because again, I don't want to play with the smaller illiquid names. Now, as an individual trader, you certainly can look at the small caps, and the same setups work inside those markets. I just look at the bigger stuff because again, I'm managing larger sums of money and I need to focus in on those larger names. Now, by looking at that, that's going to get me those stocks that are making new 52-week highs. They're the big companies, and they're going to give me a lot of solid charts. But 52-week highs don't tell the whole story, okay? So, you know, if we're just looking at 52-week highs, it doesn't necessarily mean we're looking at all-time highs, right? The S&P 500, we know that, but let's go back and let's pretend that we're, you know, back in 2019 or so. This right here would have been a 52, I think right in here, this would have been a 52-week high, but it would not have been an all-time high if I go back and look at, you know, previous years. I need to wait until I get an all-time high. So I'll take all of those names that are at that 52-week high, and I'll look at 10-year charts, and I'll make sure there's nothing to the left side of the chart. All right, and you'll notice a lot over what's going on right now, where you'll get stocks that are making new 52-week highs, but are not above their COVID levels. So if you take a look at a lot of like REITs and things like that, they've had a nice bounce, but most of those charts are still trading kind of right around this zone in comparison to COVID, whereas all the tech stocks are trading, you know, all the way up here. So I don't really want to mess around with the stocks that still have a lot of, you know, areas on the left side of the chart, because those are areas that are resistance. Price has a memory, and the reason why this works as resistance is, we'll think about this from a psychology standpoint. All right, all these people that bought in right here, every single one of these people, they just went on a horrendous ride where they were down 40%, right? And some of them held. Every single person that's holding down in here is all kind of saying the same thing. If I can just get back to even, I will be happy and I'll get out. Right? They don't want to book the loss because it's too hard psychologically to take that loss. They're going to hold on. They're like, it's going to come back. I think it's going to come back. But if I get back to even, I'm going to get out. And so we get that big bounce. And this, I mean, you could see this happen last year, right? We ran right into this area and the market failed the first time, right? It doesn't mean it's always going to fail. It failed the second time as well. It's because all these people that are in here are going, oh, thank goodness, I finally can get out even, and they're selling. All right. Plus, people can see this is an area of resistance. Short sellers will sell, and people that bought down in here, they're happy to take their profit up here as well. So you have all of those things working for you. When you break above those levels, things change. You no longer have that overhead supply, and now you have the opposite. Now you have all the breakout traders going, woo, here's a breakout. Those are fresh new buyers. Right? You got nothing to worry about over here on the left-hand side of the chart. You got that clean breakout. That's going to give us that better potential. So I make sure that we're not just trading at 52-week highs. I scan for 52-week highs because that's always going to show me that the stocks that are making those 52-week highs. But I really want to go back and make sure that there's nothing to the left, 5-10 years ago, because price has a memory. Even a decade ago, you'll run into areas where we have resistance from 10 years ago that play out as important once again. And same thing on the support side. Now, in a good market environment, I may still have 40 names a day that meet that criteria. All right. And so now I need to figure out, how do I pick the best of the best from there? Well, all stocks that are making new 52-week highs on those all-time highs, they all can be doing it very differently. Okay. So let's take a look at, let's say the Dow right here. Let's say we pulled up a chart of the Dow, and this is the day that we're at. This is where I'm at. This is a very hard thing to purchase because the breakout was back here. So it's already moved up a good ways. It's already moved up for quite some time. I need this to set up in a tradable pattern. So again, I want to see those Darvis boxes. I want to see those ascending triangles. So if I pull up a chart of the Dow on this day, I wouldn't buy it. I'm not saying I'm not bullish on the Dow. I'm saying it's not the best looking setup. All right. I would be looking for, again, more something like the Russell if it was right here, because that would be the great setup for me. So I look through all those different names and I try to find the individual names that are either in those Darvis boxes on the first day of breakout or that are on those ascending triangles first day of breakout. And then I even include one more thing inside of that. It needs to break out on an increase in volume, right? I don't want it to be breaking above a level and have very little volume for that day. I want there to be at least 30 to 50% more than the average number of shares traded. Okay. Because when that happens, that's saying that there really is a lot of interest in it. Sometimes you'll see things just barely make new highs and do it on very little volume. And then you'll oftentimes notice the next couple of sessions, it starts to head lower, right? You need volume to continue to move higher. And so that's what I want to look at. When I've gone through all of those different things, I may find 2 to 5 names a day that fit the total criteria. And if I have, again, 5 names, and let's say I'm already in 2 or 3 positions, I only want to take one more position for the day. Again, how do I figure out which one of these I should take? Well, I can do a couple things. One, as I said earlier, we could take half position sizes. So if I can only take one position, but there's 2 names I really, really like, instead of risking 1% on each of them, I could put in 0.5% on each of them. And that would still keep my risk level in line. There's absolutely nothing wrong with doing that. The other thing I can do is then I can start analyzing the sector of the market that name is in. Meaning, let's say I've got a stock that is in the Russell 2000 that's breaking out today, but the Russell 2000 is all the way back down here. Now, it's clearly a leadership name. It's one I would like to own, but I also have the ability to buy a name that is in the NASDAQ. And the NASDAQ, of course, as we know, has been leading and continuing to push higher. Between those two, if they both have the same chart setup, they both look the same, I'm going to pick the one that's in the NASDAQ because it clearly has made the breakout as an index. The whole index is leading. Again, I have a higher propensity for that essentially to follow through the upside. All right. So that should give you a very good understanding of exactly what I do. When you're building your screener out, you can include other things inside of that you want. The whole goal with those screeners is to really narrow down the entire market to focus in on the type of setup that's best for what you want to accomplish. And when you do that and you do it well, it may seem like a lot of work, but every day you basically can spend about an hour max and get a couple of really good ideas that are going to work out for you once you get that process down pat. Do you have any other questions on the breakout strategy, how I set that screener up?
No, all good, all good.
Okay, well, now I want to go ahead and take a look at a couple of the different indexes for you guys, kind of talk through a couple of different things. I'm going to give you a market analysis here. And now I'll see if there's any other questions that you guys might have. So the NASDAQ, right, when we look at this, it continues to just be in that clean uptrend, right? We continue to put in higher lows. We've had a breakout. We continue to make all-time highs. There's nothing bearish about this market. It has consistently been all year long, a leader. At one point during the year, the NASDAQ did drop negative in March, and we'll look at what the Dow did at that point in time in a second here. I wouldn't be buying the NASDAQ components back in here, right? I really was looking for this breakout right here. And we started loading up tech once again. All right. Now, the Dow, if we go back to February and March, while the NASDAQ was dropping, look what the Dow was doing. It was rock and rolling higher. This is what we call healthy sector rotation. If we look at all of these charts and we go back to last year, they all sold off together. That's not rotation. That's just money coming out of the market. But when we start looking at all the different sectors of the market, and like right now, the NASDAQ is clearly pushing to new highs and the Dow is struggling. That's just rotation. The Dow was very, very strong essentially from February to June. Then that money came back out of the Dow and started heading back into the NASDAQ components. That is healthy rotation. As long as something emerges as a leader and we continue to grind up, things look really, really well. The S&P 500 really never had the dip and has just been grinding the whole time, right? 500 of the largest companies. This is the most balanced of the indexes. It's one of the reasons why most people actually just take a look. If they're going to only analyze one, they'll look at the S&P 500. It's just been grinding higher the whole year. We've had a couple of areas where we've had a couple of down days in a row, but none of them have made lower lows. Here's the first pullback. Here's the second pullback. Here's the third pullback for the year. Here's the fourth pullback for the year, right? The fifth, the sixth, and then the one that happened last week, seventh. Look at where our lows are. Every single one of them is higher than the previous one. Until that changes, the trend is clearly up because we have higher highs and we have higher lows. And that's all we needed to know. So we should be bullish until that changes. If the S&P 500 takes out this and starts to fall, that changes the structure of the market. We're not there yet. And I know a lot of people like we've just gone straight up for a year and a half at this point in time. This thing's getting out of control. It's got to turn around and come back. And every time we get these little sell-offs, the financial media just goes, the world's ending. People start panicking, selling their stuff. Just use the charts. We have not had a reason to sell the S&P 500 the entire year. All right. That's not the case when we look at the Russell. The Russell hasn't gone anywhere. Okay. And so this, again, is not a market that I wanted to be in at the moment. If we make this breakout, that would be very, very bullish. I think what happens inside the Russell is very, very important for the overall market because it is a kind of gauge on risk, right? The mid caps, the small cap companies, when they do very well, that means people are taking on more risk. It's a lot riskier to own a mid cap company than it is, let's say, like an Apple, right? And so when you see the mid caps doing well, that means people are willing to take a little bit more risk. All right. So I'm really watching the Russell. If it breaks down, that's going to be a telling sign. If it breaks out, that's going to be a telling sign as well. And as long as it stays inside this range, it doesn't really matter one way or the other. Now we can look in at the financials. So we'll take a look in at the NASDAQ banking index. The banks did really, really good there in the beginning portion of the year. And it has started to essentially trade in sort of a Darvis box. We clearly have a resistance up here. We clearly got kind of support down here. This is kind of no man's land, right? And we're trading right in the middle of that right now. So this isn't a market I'd be interested in at the moment. If we break out to the upside, I would be very interested again. When we look at a lot of these charts, we'll see that that's, something that's going on. Here's the semiconductor index. The semiconductor index has been slowly grinding higher here, over the last 6 months, but really not accomplishing much of anything, right? Marginal new highs. We're talking like 1% above previous ranges. It's more so just kind of trading sideways with a slightly upward bias. There's not really a trade that I'd be interested in here at the moment. I would certainly not want to see it fall underneath it here. And if it does make a new all-time high, that would be good. Honestly, the names inside the semiconductors are some very good looking individual charts, but the index as a whole bias to the upside, but not necessarily a super tradable setup. The green energy space had one of the most incredible runs last year, and it has really struggled this year. All right. And after such a move last year, that's not really a surprise. It's just kind of a cooling off period. This is a nice long 8-month range. If it were to break above this, we still have all this resistance over here. So this is not something I'm necessarily interested in from a trade at the moment. I am always watching to see if we break above those highs at the beginning of the year. If we were to break above that zone, then I'd be back interested in again. But this really hasn't accomplished much of anything for 6-8 months. All right, the transports. The Dow Jones transports are always important to pay attention to. It shows you how goods are moving around through the economy. Now, I know we have a lot of supply chain issues and everything that's been going on with COVID, but the transports have done very well, especially at the beginning of the year. Still, year to date, they're up pretty good. Kind of haven't done anything for 2 months. So really, I'm kind of looking at it like this. We kind of have this whole range. The middle of the range is about that 15,000 zone. Over 15,000, we probably come back up and test those all-time highs. I'd be very interested in owning that space over that 16,000 level. We could take a look in at Bitcoin, which I know a lot of traders are very interested in. We did not make a lower low for the year, right? When you're actually looking at the chart of Bitcoin, these pullbacks right here actually didn't take out the low for the year, which is about 28,600, I want to say. So we had a pullback right into support. And here's kind of that Darvis box over the last couple of months and a breakout to the upside recently. But we have a lot of overhead supply. So it makes it very tough to try to buy Bitcoin right here at 50,000 when you got resistance at 52.5 and at 60. It's easier to buy on those support levels because you can control your risk better. Or as I like to trade, I really want to look for this to make new all-time high. If it makes a new all-time high, I'll be very interested in once again. The housing market is looking pretty solid. It's still trading up near those highs, but we haven't taken them out yet. So again, you can see a lot of these sectors that we're looking at here under the surface of the last 4 or 5 months, they haven't accomplished much of anything, but the overall indexes are trudging higher. All right. That is that sector rotation from one area of the market to the next area of the market. Utilities broke out the other day to new all-time highs. That's kind of right in this zone. I certainly would make a buy in this space over that 913.25 zone, because this looks like this could be a multi-year, breakout in the utility space. The oil services area, this is when we talk about lots of issues on the left-hand side of the chart. So all the names in the oil space were making new 52-week highs, but having all this issue over here to the left-hand side of the chart. So these were not things that I was interested in buying as oil was pushing up into that $75 a barrel zone, because we have all this issue to the left-hand side of the chart. It's an area of the market that's been beat up for many, many years at this point in time. And I am not trying to pick and choose what areas of the market are going to come back and which ones aren't. I'm focusing in on those breakout trades, period. We can look at the gold bugs. So the gold and silver area of the market had a really strong year last year, hasn't done anything for the most part this year. It's been just a year of down and sideways movement after an incredible move to the upside. It's not an area that I'm interested in right now. If we kind of hold this level and bounce back up, that could certainly change. But at the moment, it's really not somewhere I'm really super interested in paying attention to. The US dollar is having a lot of issues right here at this $93 to $94 zone. A breakout wouldn't be great for the emerging markets. Everything is priced in the US dollar, and then, kind of has a headwind. This has been a kind of long sideways range that we've been in now since last July, where the dollar hasn't done anything. If we're going to get a move up or we're going to get a move down one of these days, the dollar moves very slow. A move to the downside would be bullish for commodities and for the emerging markets. A move to the upside would be more bearish. Right? We obviously can have a strong dollar and markets still be strong. It's just, it adds a little bit of extra pressure. So we're watching that pretty closely. And I mentioned oil. Here is a perfect example of, again, a 52-week high. Oil broke out at $68 a barrel. It's a 52-week high. And look where it ran into. I'm going to put this on a weekly chart so it's a little cleaner. It ran right into the highs from 2018. If you don't look at the left-hand side of your chart, you're buying in here expecting something to continue to head higher when really you're buying it right into resistance. And that's why we use those bigger time frame charts to make sure we're not running into anything. And I called it out earlier this year. I said oil, was going to have a lot of trouble when it got into that 75 to 77 zone because of 2018. We pushed right up into that, and we have struggled from that point forward. So as you can see, kind of going through all this, the S&P 500, a lot of, the NASDAQ, the Dow, they're making new all-time highs. Underneath the surface, we've got a lot of areas of the market that are just trading sideways for a while. I think we're probably going to get a pretty substantial move here in the last quarter of the year. We're going to, follow whatever direction it is. Hopefully, a lot of those indexes that we just laid out for you are, resolve their ranges. They'll resolve them to the upside, but they don't have to. They can stay sideways for another 6 months. We had an incredible push higher. Moving sideways for a long period of time is healthy. There's nothing wrong with it. The Russell's a great example of it, right? After such a big move, digesting that move is great, right? Price essentially can digest these incredible moves in two ways. They can trade sideways for a while, or they can have big pullbacks, right? It's obviously a lot more constructive and healthier when we get these sideways moves, especially because when we break out, we have a very clean chart. A lot of people can see it, and we typically tend to get that follow through. So that's everything I prepared for you guys today. I guess I'll open it up for any last questions that you might have.
Thank you so much for that detailed presentation. And yeah, I'm gonna take some questions that came in earlier on. So we have 2 questions I see, and guys, feel free to type in your questions right now. So Oscar is asking if there's a specific signal that you use for your entries. Oscar.
So the specific signal that I would use is a breakout to new all-time highs, a close over that level, with a volume over 30% the average volume that traded a day. Meaning, if a stock was trading 1 million shares a day on average, I want to buy if it's above that breakout level and there were 1.3 million shares or more traded that day. And you can compare volume to different times of the day, meaning if you're buying a breakout at the beginning of the day and not waiting for a close, you can compare the volume at the open versus the volume at the open over the last week or two, and you can clearly see if there is a big volume increase or not. And if there is a big volume increase and you're not waiting until the end of the day, you can do that calculation and make that purchase there. If you're waiting until the end of the day, within the last 5 minutes of the day, you should have a very good, understanding of whether or not volume has increased for that day or not.
All right. And then James Miner is asking how you calculate your risk and take your profits. I think you answered that, but maybe you can touch more on that.
Sure. Just so let's say we were buying the Russell here. Let's say the Russell was breaking out. We were back up here at this 24,000 level. Here's what I would do in this. I would take that entry point here and I would use that last key low, which is all the way back down here. That's where my stop is going to be. So my entry is going to be here. My stop is going to be here. And my targets, I'm going to take that to that breakout spot. And I'm going to get an upside target of $2,675 would be my entry point. Now, again, let's do the quick, simple math. Let's say our entry point was at $10. Our stop was at $9. We would take the entry point and subtract where we would stop out, and that would give us a number. In that case, it gives us 1. And we would then calculate 1% of our total account value. So let's say this time you have $50,000 in your account and you're risking $1 per share. 1% is $500. You know that you could buy 500 shares. That would give you your $500 risk. And you know that if it got all the way up here, you would make your $12.40. So you'd make $640 against a $500 risk. Software that I use for trading on my computer, this is Thinkorswim from TD Ameritrade. It's free with their brokerage account. So I think this is a very, very robust. There's a lot of free ones out there as well. Really, all you need to be able to do is you need to be able to set alerts. It says I will do that. So if I'm looking at a chart like this, I can actually go in and create an alert so that I will get a text message notification if it breaks above this level. That's very, very useful when you're going through a ton of charts. I probably have 500 plus alerts set up so that if something does break above a particular level, I'm alerted to it. I don't need to look at the chart every single day. So that's very, very useful. And if you guys are interested, there's two other things. If you want to set a screener up, FinViz, I'll type it in the chat, but finviz.com gives you the ability to have a free screener in here where you can go through and choose a bunch of different fundamental and technical components to this. So you can really, quickly take a look through the market. So I think that is of good value. And last but not least, if you guys are interested in what I do, you can come to perspectivewealthplanning.com. I have a coaching program where I work one-on-one with people. We also do everything related to financial planning, as well as money management. So feel free to reach out to me or my team, and we're more than happy to walk you through a free financial plan and help you out in any way that we can.
All right, good. I think you have answered the question on how people can reach out to you. Thank you so much, Mike, for your time. Thank you for your lessons. We'd love to have you again in the future. And guys, Mike has taken us through breakout swing trading and focusing on stock indices. If you wish to apply the lessons, you can do so. Stock Markets has indices as well on the asset classes that you can use to trade. So unless there are any more questions, I think we can wrap it up. Oh yeah, so Joe Batak, can I have a copy of the recording? Yes, these recordings, we usually upload them on our YouTube channel. That's at Sylvia's Traders Lounge Forex channel on YouTube. So be on the lookout for that next week. All right, so thank you, Mike. Do you have any parting shots for us as we go to Q3 for in terms of trading?
Like I said, I really would just pay very close attention to that Russell 2000, because I really do think whichever way that big range ultimately breaks, the overall market's going to go with it. Hopefully we'll break into the upside after, such a nice long digestion, but you never know. So we're just going to pay attention and go with whatever the charts give us. So thank you so much for having me. And yeah, I look forward to seeing you guys again sometime in the future.
All right. Thank you, guys. So we'll see you guys next week on Friday for another webinar. All right. Cheers, Mike. Have a good day.
See ya.
Thanks, guys, for tuning in and sticking with us to the end. We hope you have learned something new. I would like to appreciate Scope Markets for sponsoring this webinar. Remember, you can open a live trading account with Scope Markets and apply the lessons shared by the guest in this webinar to your trading. Many thanks to our guests for speaking to us. We'll be open to have you in the future. Till next time, goodbye.